So what exactly is the point of trading? Why should you put yourself through the many months and years it takes to actually learn this stuff and to become successful at it when you can simply just put your money into an index fund, for example, that tracks the S&P 500, and you'll generate a pretty decent return and there's no work involved. So again, I ask you, why should you even bother with trading? Well, in this video, I'll be giving you two of the main reasons why trading is actually worth the effort. The first reason I think you'll find is pretty obvious, but the second one, not so much. But that is the one, in my opinion, which is the most important. Now, as always, before we get started here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, and so the first and more obvious reason why trading is actually worth the effort is if you are trying to generate outsized returns, or basically returns beyond what the market will typically give you. So for example, like I mentioned earlier, if you were to put your money into an index fund that tracks the S&P 500, then historically, the S&Ps have gone up on average by about 8 to 10% per year. And the reason why I say 8 to 10% is because it does depend on which particular iteration of the S&P 500 index that you're looking at. So if you're analyzing the original S&P 500 index, which I believe was introduced in 1926, then that index has averaged about a 10% return per year. But it wasn't until 1957 where all 500 stocks were actually introduced into the S&P 500. So if you were to judge the S&Ps from that point in time forward, then you would see an average return of about 8% per year. So regardless of how you are looking at the S&Ps, somewhere around 10% on average annually is what you can expect with a simple passive index investing approach. But like I said, if you do want to generate a return beyond that point, 15%, 20, 25 and beyond, that's one of the main reasons why you should consider trading. Just keep in mind, however, that trying to quote unquote beat the market, especially on a consistent basis, is extremely difficult, especially when you factor in all the capital gains taxes that you'll be facing every single year. And typically when people talk about trading, they're talking about short-term trading, either day trading, swing trading, whatever. But unless your positions last more than a full year, you will be taxed at short-term capital gains, which is basically just income tax. Or also, if you are like myself and you sell options, then it does not matter what you do. You will always be taxed short-term capital gains if you're an option seller. And also if you short stock as well, in most cases, that's also considered to be short-term capital gains. So as a basic example, let's say you wanted to generate a 20% return after tax. And let's also say your total combined income tax rate is 30%. So based on those numbers, that means in actuality, you really have to generate a 28.57% return to, after tax, still make that 20%. And the way you figure that number is simply by taking your target annual return before tax and dividing it by 1 minus your income tax rate. So 20% divided by 1 minus 30%, which is 70%, equals 28.57%. This is your before tax return that you must generate. Okay, so that is the first main reason why you should consider trading and why it could be worth the effort. But like I said, trying to beat the market is extremely difficult, so I would not put too much weight on that particular point. The second one, however, is much more important in my opinion. And that is if you are trying to generate uncorrelated returns to the broader market. And this is the main thing that I'm trying to do with my own options trading. Of course, I still do try to generate a return that is beyond what the market will typically give you on average, but I'm much more concerned about generating uncorrelated returns with the S&P 500, for example. And this basically means it is completely irrelevant where the S&P 500 ends up for the year. It could be up by 20%, could be flat, could be down by 12%, does not matter. The return I generate in my own portfolio is completely independent of what the market is doing. And this point should matter a lot to you as well if you are also concerned about the short-term prospects of the general market, right? We've basically been in a bull market for the better part of 12 years at this point. And I don't really consider the crash of 2020 to be a real bear market because it was only a couple weeks long and the Fed swooped in and basically saved the day. So really 12 consecutive years of straight bull market. And like I mentioned earlier in this video, the average annual return of the S&Ps historically is about 8 to 10% per year. But if you look at the past 5 years, for example, the average return of the S&Ps is well beyond that point. right? In this current year, 2021, the S&Ps are up over 20%. In 2020, the S&Ps were up 16%. In 2019, 29%. 2018 was the only down year of minus 6%. And 2017, again, up by 19%. And when you take the average of those past 5 years, you get an average annual return of 16%. And finally, you can also look at the S&P 500 P to E ratio, or price to earnings ratio. This is a great indicator to tell you how overvalued or undervalued either a certain stock, or in this case, the market as a whole, may be at a point in time. And so if you take a look at this chart, which shows you the P to E ratio for the S&Ps, obviously it's not at the all-time highs, but it's still much, much higher than historical averages. Basically, the point I'm making here is I personally do think current equity valuations are astronomically high. They're pretty much absurd in my opinion. And that's why I'm also of the opinion that at some point, probably in the relatively near future, we're going to see a very large and long-term correction in the market, right? Not some short-term crash that we saw in 2020 and also where the Fed just kind of bails everybody out by printing trillions of dollars. I'm talking about potentially a real bear market that lasts for a year or longer. And I'm willing to bet that any sane person looking at a chart of the S&P 500, or especially the NASDAQ, can look at that chart and say, yeah, this is sustainable. Now, of course, I could be totally wrong about this stuff, and we could just keep seeing the market climb higher pretty much every single year going forward. But if you are also worried about current valuations like myself, or if you're simply looking for a way to generate a return that does not solely rely on the market climbing higher, then perhaps trading is a great thing for you to try. Just keep in mind that trading is difficult and it will take some time to really learn how to do this correctly and to eventually succeed at doing it. And so with that being said, that's going to conclude this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.